Welcome to the latest episode of the Intelligent Wealth podcast. Our podcast is designed for serious investors, particularly quality investors, people who like investing in companies that have got great quality for the long term. This isn't really for people who aren't interested in those kind of things. We really do study markets quite a lot and do study great investors, do a lot of reading. So we want to share lots of ideas with you to make it interesting and valuable to you. So today I've got my usual team member guests here, Awet, who is Head of Research at Minerva Money Management, and Carl, my fellow director at Minerva Money Management. Probably fair to say he's more on the technical compliance side. I think that's a fair comment, Carl, but not the only thing you do, of course.
Makes it sound a bit boring.
Yeah, no, far from it. Anyway, what I'd like to now do is move on to the main topic of today's podcast, which is growth investing. So I'll just kick off with explaining what I understand by growth investing. It's really a strategy aimed at boosting an investor's capital by focusing on growth stocks, simply. These stocks typically belong to young or small companies projected to have earnings rising faster than the industry average or market as a whole. Now, there are advantages and disadvantages to this. And also, I feel a lot of terms are bandied around for different styles of investing. But when you think about it, all styles of investing are ultimately about growth investing, aren't they? Because you don't want to buy a share that's going to go down in value, do you?
Of course not. Yeah.
What do you think, Carl? What's your view on all this?
Yeah, I think you're right. When we're talking about growth investing as an investment strategy, I suppose the key differentiators are that you're much more focused on revenue rather than profit as such, because you're in it for the long term and you're predicting a really great future for a company, essentially. So whereas a value investor or maybe even a quality investor will want a proven business model, profitable company, growth investors tend to think, right, well, that will all come, but in the future. So for now, the companies are making great revenues, but they're pumping all that money back into the business because they see an even brighter future in the long term. So typical statistics you'd be looking for is very high PE ratios on growth companies as opposed to value companies. Much more longer term focused.
Good point. What about you, Awet?
Yeah, I mean, growth. You can still invest in growth businesses that they still, they have a proven business model. Like I will talk about a few companies that later on. You can still have a great business that they have a great business model, but they're still growing. Like Nvidia, we've seen. Nvidia market cap is more than 3 trillion, but still, you can argue it's a growth stock. So growth can be found even when you invest in value stock. I mean, you can calculate the valuation, but you still want the company to grow and to allocate capital properly. And so that there's a cycle that over time there's a growth for the market. Otherwise, it wouldn't be a good investment. Just looking at the valuation, if there's no growth in the long run, it will be a value trap. You're just buying something cheap, but it doesn't have a scope to grow. So growth, I think, with all investment has to be some sort of growth in the future. But when we say growth, maybe here we predicting like 10%, and there's a growth 20%, 30%. There's a stages of growth as well. So we're talking about maybe more than 20% here, maybe, I believe, because you want a company to grow significantly to be considered as a growth stock. So overall, I think growth is a key in every investment, and it has to be part of the calculating the intrinsic value and so on and so on.
Of course, the companies that are young, if they've got a very good business model that's proven and it's very profitable, in the early stages, they've got to invest far more in R&D and marketing than more established companies, because they know that their sector works and they've got an edge on other companies. So they've got to plow more money. And having said that, we do seem to have this very great anomaly these days where the Magnificent Seven are defying all the odds and not only are they investing the most in R&D in the world, they're also getting phenomenal annual returns, which just is opposite to what you'd normally expect, because historically it's always been smaller companies and mid-sized companies that have had the greatest returns. But we're going through this very strange period with technology in particular, where the tables have been turned a bit. I don't think that will last forever, but it's certainly an interesting trend.
I think growth investing does tend to lend itself towards technology companies, because for growth investors, it's all about innovation. It's like you look at the future and the next big thing. That's where the growth companies come from, and that's what we've seen in the last 10 years or so with the Magnificent Seven companies. They've just completely changed the way we work and live. And that's why they're labeled growth stocks. I mean, you could argue now they're transitioning into legitimate, stable kind of companies now, rather than growth stocks. But there's going into areas like AI, you could argue on the other side, actually, there's more growth to come, because there's more innovation to come that way. But also, it's not just about companies. You could look at countries as well. So there could be growth countries, particularly if you look at the kind of Asia markets. I think isn't something like 70% of the world's middle class are going to be living in Asia by about 2030. So you've got growth countries as well as growth companies.
Yeah.
Well, you've already got a situation where there's more millionaires living in India than there are people in the UK. Well, the trouble with India, though, is 90% of the population is still poor, but it's a huge population. So, Awet, didn't you want to mention a couple of companies in particular as good examples of growth companies?
Yeah.
Tell us about those.
Sure. I prepared, like, the fund invested in these two companies, and I prepared two companies that I think they are positioned to grow. The first one is Mercado Libre. You guys probably know is the Amazon. Some people call it in terms of a combination of eBay and PayPal, which is and so I call it the Amazon of Latin America. And Mercado Libre they operate in around 18 countries in Latin America. Mostly, most of their revenue comes from Brazil, Mexico, and Argentina, which is, I mean, Argentina is not the most stable economy, but they found a way to overcome that in Argentina. So the company is run by a founder, Marcos Galperin, and he has around 7.2 stakes in the business. He's proven to be great capital allocator, and if you invested in the business in the last 10 years, you will have compounded around 34% in the last 10 years, compounded growth. So it has been a great compounder, and it's not price expensive. When you look at it, it's priced around around 18.5 times free cash flow. So it's not too expensive, but at the same time, you get an exposure to, as you say, the middle class that is growing in the Latin America, Mexico, for example, and Brazil. They are expected to grow. And one thing this company uniquely is doing is not many companies that they went to the Latin American market and succeed, but this Mercado Libre, they have expertise, they have a first mover advantage in the region, so they have done really well, and they will continue to do really well in the long run, because that area is growing and people don't have access to finance in that region, and this company is just providing all this access, e-commerce, and they have amazing logistic capability to do that. So this is a company that I believe in the long run it will do really well, and it's just run by what we like, founder, owner, and so on, and good allocation in capital, and it's just a region that you want to be exposed, but you don't want to take a bigger risk, where Mercado Libre is diversified and growing in that region. The second one, do you have any comment, Tony? Or
sorry, can I just make a couple of comments about Mercado Libre? Sure. Typically, people don't like to invest in South America because the currencies are so weak against the dollar.
Yeah.
But what's unique about Mercado Libre, they've got great expertise in foreign exchange. So they hedge the exchange risk very skillfully. That's the first thing. What was the other point I was going to make about them?
Maybe
I do like the fact that they're this combination of eBay, Amazon, and what was the other one? PayPal. So it's like three great American businesses all in one. I think that's quite remarkable.
Yeah.
So yeah,
What's the PE ratio, Awet? Just out of
The
interest.
PE ratio for Mercado Libre is, let me have a fun. I think that when you look at it as a PE, in terms of, because we focus on the price to free cash flow,
Yeah.
which is because it's an accrual
Yeah,
accounting.
but in terms of growth investors, just to show the point that
Sure,
you know,
the PE ratio is around 44
yeah,
times.
which
And
just goes to show you that you're less worried
yeah,
about that metric being a
yeah,
growth investor.
yes,
I mean, just in terms of comparing it to value investing,
yeah.
the Russell 1000 Growth Index
Mhm.
has around, as an average, long-term average, has a PE ratio of around 25 compared to
Right,
the value index, which has a PE ratio of 15.
right.
mm,
So, but what I would say with
that's
growth
really good.
investing is I
Mhm.
do believe it's slightly more risky
Mm,
because you are betting on the future. You're taking a longer term view, and not
mm,
every company's going to get it right, are they?
Yeah, I mean,
mm,
interesting point. Like, even though the price to earning ratio, which is you are dealing with accrual accounting, which is the company are have they receive the earning, they have the earning, but they haven't received it. But when you look at the less risky one, free cash flow, which is the cash accounting, which is the most accurate one you can rely on, is trading around 18.5 times, which is not really is you can argue that's the best PE ratio, because you're using the cash on the cash of the business. So you looking at this cash account, I think the company is not too expensive. It's just like when you mentioned the value is 15 times PE. This is actually 15 times, 18 times free cash flow, which is very close, pretty much.
yes.
Um,
Awet, can I ask you,
yeah,
have you prepared a company snapshot for Mercado Libre yet
I,
for our listeners? Because if
I
not, why don't we produce one? And after the show, if any listeners would like to get a brilliant one-page summary of Mercado Libre and the next company that Awet's going to talk about in a minute, by all means, contact us, and
sure.
we're happy to share.
Yeah, definitely. We already have one actually, so we were happy
Great.
to share
Okay.
that. Anyone who requested. So yeah, we have a and we invested. I think it makes a big one of the top holding in the fund as well. We are optimistic about that area is the growth in that region. The second one is you probably know this one is cybersecurity. I've written a blog about cybersecurity, and this company called Fortinet is
Mm,
cybersecurity and networking solution company,
mm,
is based in the US. And the reason is, if you look at the cyber crime is rising. I think in 2019, it was 1.2 trillion lost due to cyber crime. And in 2022, there was 7.1 trillion. And now by 2028 is expected to be around 14 trillion lost um, from cyber attack. If you think about this statistic, what you find is cyber crime or cyber attack is a sort of war. I mean, the internet is becoming bigger and the complexity is becoming higher. So um, it, most companies and countries, they have to defend their critical infrastructure from cyber attack. So this
mm,
company is well positioned in that market. It's the good things, it meets our criteria where it's run by the founder, Ken Shi, which is he's been running the business for 25 years, and his brother, which is together they own around 18% of the business, which is
mm,
significant ownership.
mm,
And they have a big partnership with companies like Microsoft, Google, and Amazon, and so on. So if you invested in Fortinet in the last 10 years, you would have compounded close to like 33%, 33.2% in the last
wow.
10 years.
Yeah.
Yes. So, and the market is expected to grow by more than 10% for the next 10 years. So it's a huge market and huge addressable market. And they have proven to be very well capital allocators. If you look at the return on invested capital in the last 5 years, is around 20%, and price to free cash flow is around 30 times free cash flow. So it's a really good business to be in. I think for anyone who is considering any investment in the cyber industry.
Mm, mm. They are superb figures, of course.
Yeah,
Again, if we have a company snapshot on that? If we don't have, let's create one and make it available to our listeners.
we do have, but we do have
Fantastic.
as well. So yes.
Yeah. And it goes without saying, I didn't mention this at the start,
Yeah,
but obviously these aren't recommendations. Let's
of course.
emphasize that.
Mm.
These are just companies we believe in. You still need to do your own research. Don't treat this as a recommendation, but we're just talking about the companies we like, whether we're invested in them or not, that
Yeah.
suit our investment style. It might not suit yours. So, that's the warning, really. So, anything more to say about growth investing? Any particular advantages and disadvantages we haven't mentioned so far? One thing I was going to mention was, don't these stocks tend to be a bit more volatile than say value
Yeah,
stocks?
there's a couple of risks that you need to be wary of on growth stocks. So yeah, definitely the volatility tends to be higher. So again, if we go back to the year 2000 up to 2020, the Russell 1000 growth index averaged a volatility rate of 19%, whereas for the value index, it was down to about 15%. So generally more volatile than, say, value companies.
Yeah.
Of course, another characteristic of growth companies is they don't tend to pay dividends because obviously they're reinvesting profits and revenue back into the business to kind of keep growing that innovation that they're driving. So again, the Russell 1000 growth index, only 30% of companies pay dividends, which I thought was still quite high for growth companies, to be fair, compared to 60% of the Russell value index that pay dividends. And I think that the other big thing was, other two major things with growth investing is, one, it's very sensitive to economic conditions. So in the last 10 years, obviously we've had very low interest rates around the world, really, and that suits growth investing because the discounted cash flows, the ability for these companies to sort of borrow money, get cheap debt. So it has been, the market conditions have been very favorable for growth investing. Obviously, it's slightly flipped around the last year or two. So there's an argument, we go into more riskier times for growth companies. The other thing I would say is that if you're a growth investor, you're going to be quite concentrated in the US. Because looking at a stat the other day, I think globally over 50% of the world's unicorns, which are startups valued over $1 billion, are in the US. These are obviously all the future companies that are not yet listed that will, you'd think come onto the market at some point in time. So a massive over concentration in the US stock market. But yeah, so there's got sort of some of the risks there. And I mean, just in terms of, obviously, most people will be aware of the success stories of growth companies, the likes of Amazon, Tesla, Netflix. Awet's highlighted a few others there, but there's also quite a few that didn't make it. Does anyone remember WeWork?
Yeah.
Yes.
The service kind of offices and things that just at one point in time their valuation was 47 billion.
Yeah.
At its peak. But then, failed IPO in 2019. But obviously, everyone thought that was the future of work, following kind of COVID and things.
Yes.
Another one is BlackBerry. Do you remember the old BlackBerry phone?
Yes.
Again, they were the kind of iPhone of their day, weren't they? Apple kind of stock.
Yes.
But obviously failed to kind of keep innovating and eventually kind of lost their way. So I think the key difference is with growth companies that survive are the ones that constantly innovate, have that long-term vision like Amazon,
Yes.
and are able to execute that. The ones that don't survive are the ones that kind of have these unproven business models. Like they become popular in the short term, but have they got a long-term proven business model that's going to work?
And
or are they just the levels of growth?
Do they even have a monopoly?
Unsustainable.
What about that? There was a fitness equipment company that got very popular, wasn't there?
Peloton.
Yeah,
Peloton. When you like WeWork's Peloton, you're thinking, hang on a minute, other companies do this as well. What's so special about them? It's not really a monopoly type situation, is it? Unlike the likes of, say, Alphabet, with all their monopolies.
It's a risky strategy. If you're a growth investor, you definitely got to be careful with the risks you're taking. And I think we've said this stat before that I'll say now that since the US stock market from 1926 to 2016, only 4% of listed companies account for nearly all of the net wealth created in that market during the time. So the other 96% of companies either just broke even or destroyed value over time. So that just shows you how hard it is to pick these winners over the long term.
Yeah, I think an interesting point as well. Like in during COVID, I think if you remember, Zoom was rising. That was a growth stock. But one thing, I think it was the valuation was rising. Everyone was Zoom. I understand, but the reality is people didn't think Microsoft, Google, they were just doing it for free. Why would you spend so much money? So and that's why I think after COVID that Zoom stock has crashed down. And the key thing is there are a lot of growth stocks, but you have to make sure the business model is robust and it can sustain a test of time. And that's when I think Warren Buffett said, and when things get bad, that's you will discover who is swimming naked. So that's when the proven business model will stand still, but the one doesn't have a good business model will just die down slowly, like we've seen with Peloton and what you mentioned. They just don't have that business model. I think there was a car company as well. They just put the cars in the box, but they just it's similar to what the car companies that automobile that you go to. They just came and they stopped. Price has gone up significantly, and it just came crashing down because they were just car company. They sell cars pretty much. That's all they do. So I think people need
to constantly innovate, isn't it? Like, if a growth company to stay successful long term, you just got to constantly be innovating. So that pressure must be huge.
Yeah, definitely. And the pressure and the finance you need to invest on R&D to stay innovative and so on. I think look at companies like ASML, the Dutch company. The amount of money they spend to stay ahead of the game is significant. And to do that as well, you have to have a very profitable business model to sustain that, to give you the money that you want to invest, recycle that to invest it and do it. Like that's why I do think even though historically the big seven, most companies fail over time. They do replace and by other businesses, but the big seven, they do have a good business model that generate cash significantly. And to do that, it will allow them to stay innovative and so to invest that money and so on. So that's a key thing.
The key thing with the Magnificent Seven as well nowadays is that they've got quite diversified income streams, haven't they? I mean, not so much the likes of Facebook, I think, and even to a degree Google. I mean, a lot of that. Well, profitability wise, a lot of their profit comes from kind of advertising.
Yeah.
But in terms of revenue, they've got quite a lot. Especially the likes of Amazon, probably the best, isn't it? I think that the most of their profit comes from their web service, not the selling of the retail kind of items and things. So,
but the other thing I like about Amazon, about Jeff Bezos, is that his philosophy is that he has to reinvent the business every day. So, in other words, this is an owner, a visionary founder owner who never sits on his laurels, every single day seeking improvement and absolutely obsessed with customer service.
Yep.
And of course, we experience it personally. If I'm going to buy something and it's available on Amazon, I'm not going to go anywhere else because I know I'll place that order and it will be delivered the next day. I love that obsession with service. I think that's really good. So you constantly want to improve, never sit resting your laurels, because I get reminded of this when I drive to the railway station in Milton Keynes. I drive past a Toys R Us empty building with all graffiti over it. And I think this is a company that didn't move with the times because Amazon was able to undercut them and deliver to your door the next day. And Toys R Us never changed their model, so they went bust. So I think you're right, Carl. You've got to constantly improve, constantly innovate, constantly be obsessed by customer services. They're the ones that will succeed and will never rest on their laurels.
Yeah. It's not the stronger that survive over time, the one who can change and adapt to the new market. That's, I think, companies need to evolve and listen to customers and just adapt. If you don't adapt, you will die down and someone will replace you.
Yeah. It's like the survival of the species, isn't it?
The
strongest survive.
Yep.
So anyway, as usual, very interesting discussion between us all, even though I say so myself. I'm a bit biased. So we're on to this interesting part of the show where we talk about our own recommendations. It could be a book, could be a podcast, could be a video, whatever floats your boat. So, Awet, what pearls of wisdom have you got to share with us today?
I think I've read this book called Good Profit by by what was his name?
George Koch.
Dirk Koch. Yeah.
Be careful how you say that.
Yeah, it was a great book. It's actually the book emphasized on creating value for others. I think is the key thing is, well, I was writing the blog the other day. What I discovered is businesses that create value for others, as you mentioned, Amazon, they obsess about customer service. In fact, the foundation of their business is customer service.
Yes.
And I think what you find is most businesses that, do the best for customer service and they are purpose driven, I think they're the one who can thrive. I think his stress basically create value. The more value you create, the more the business will thrive over a long time. I think it just reminded me what Warren Buffett said: time is a friend of wonderful business and the enemy of mediocre business. So the key thing is, if the business is not creating value and not purpose driven, over time, those sort of businesses are the one that don't make it, the one that they have this purpose and they are driven, the one that they thrive and make it to the 4% that Carl, you mentioned earlier.
Very true. How about yourself, Carl? I'm sure you've got an interesting one this week.
Yeah, I've got a podcast this week. I think we've recommended this podcast a few times on the show, but one episode I've listened to recently of the Investors podcast, their Bitcoin Fundamentals series. I think it's episode 200. The episode it's titled Base Fiat Money with Matthew Basinskis. Hopefully I pronounced that right. But this is a really interesting chap that monitors basically the global money supply. So all the money that's out there in the system, so it could be that what central banks hold, the actual physical cash, in shops and things. He's actually been tracking this over a number of years now. And what's really interesting about it is that he can see the actual level of money printing that's been done, particularly in the major economies around the world, and ultimately comes up with the true rate of inflation, global inflation. And he puts the figure at around 12.5%.
Wow.
So, he believes that. You look at some of the charts, he's got a fantastic website. And some of the charts, it's just exponential growth in terms of the money printing that's been going on. So, it's a bit of a worrying sign for fiat currencies. But really interesting podcast.
That's interesting, because if you were to measure global inflation without money printing, it's probably much lower, around about 2 or 3%, I guess. So that shows the effect of money printing. That leads me on quite nicely to my book recommendation this week, which is Lynn Alden, a lady who wrote this book called Broken Money. It's a history of money. It's starting from, shells, cowrie shells, all the way through to coins and notes, moving on to gold-backed fiat currency, and then on to Bitcoin. And she thinks that's the future. A lot of people do think that now, although it's divided opinions. No one really knows. But this lady is incredibly knowledgeable, and it's a great learning experience to read this book. So I'd highly recommend that one. I'd sadly become towards the end of the show now, but I'd just like to remind you, we'll put links in the show notes. If you want any of these one-page company snapshots on some of the companies we've mentioned today, like Mercado Libre, Fortinet, and others, by all means, contact us. We're more than happy to share these with you. And also, my colleague Carl always reminds me to ask people to leave a review for the podcast on the Apple Podcast app, because that helps us rise up the rankings and allows us to attract more quality guests for our one-on-one interviews. And we've got quite a few very interesting ones coming up. So all that leaves me to do is to thank you, Awet and Carl, for our usual stimulating conversation and thoughtful insights. And we very much look forward to you joining us on our next show. So bye for now, and have a great day, and happy investing.
Thank you for joining us today. Please help us spread the word by sharing this podcast with your family and friends. And don't forget to subscribe.